All right, welcome everyone to another Rocket Dollar webinar. This is the first one of 2023. I'd really like to welcome Percent today. Just some quick disclaimers right at the beginning. We are recording this webinar. That's always a constant ask. And we are also experimenting with live streaming on Facebook. We could not get YouTube live streaming to work today, but it's a really common request from our clients and prospective clients to check out a recording because they're busy during the day or throughout the week, sometimes on the weekend. So we have Percent experts in the private credit space. I'd really like to introduce Nelson and Prath here today that are going to be giving a presentation. Nelson, why don't you take it away?
Perfect. Thanks so much, Brendan, and thanks so much for having us. We're excited to share more about everything we're building here at Percent. So without further ado, let me just start sharing our presentation here today. Awesome. So, actually, hold on one second.
And while he's pulling that up, I'm just going to let everyone know why we do these webinars. We do these webinars as education and introducing, our clients or prospective clients to people that offer investments in the alternative space. A lot of our clients might come to us with a certain specialty in real estate, maybe loans, crypto, crowdfunding. They have a good expertise in one asset class, but they really don't know the entire breadth of the alternatives world. So part of this webinar series in education is to expose our clients to different asset classes and really bring in some outside expertise to talk about these investments. All right, I had your slides.
Thank you so much for that. Yeah, perfect. Let me start sharing now. Appreciate for buying us some time. There were some technical difficulties, as they inevitably always happen. Here we go. All right, perfect. So we are Percent, and I'm pleased to give you an introduction to private credit today. Our job is to really unlock yield and diversify portfolios for investors like you. These are obligatory disclosures we have to provide, so you can read this on your own. But at the end of the day, this is not a presentation to sell securities ultimately. And so, please do read this at your own discretion later on as part of the recording and things like that. So brief background about myself. I'm the founder and CEO. I've been an investor and advisor to companies that have created over $1 billion in equity value. We're probably most relevant to this conversation today. I am a former Merrill Lynch, Bank of America, BlackRock employee in my starting my career. I'm joined today by Prath Reddy, who comes with 12+ years in investment banking, primarily in debt capital markets, doing the origination, the structuring, and the execution of fixed income securities. And he is former UBS, Accredited, John Hancock, Goldman Sachs. So without further ado, let's jump into a little bit about Percent and sort of what we do and how we got here today. And then Prath will take over some of the private credit side of the equation here. So we are focused on the $7 trillion private debt market, right? It's a tremendous opportunity here for accredited investors, borrowers, underwriters to get access to these deals. These are structured transactions. It's critical capital that a lot of these borrowers need to be able to scale and grow in the way that they want to. And it's historically, again, private, so it's not something that's very easily accessible. With platforms like Percent, accredited investors can gain access to this and get diversification and yield coming out of it. So we know all of this, we've heard it from all of you, but everyone's looking for more things beyond traditional equity and beyond traditional public market fixed income, right? Just to be able to get that diversification and yield in a market today that's very volatile. And the beauty of it is private credit actually offers both. It's actually uncorrelated alpha at the grand scheme of things. But traditionally, it's actually been very difficult to get to it and get access to it. Finding it is actually very difficult. There's no real centralized market to be able to do it. And because it is private, there's not a lot of data available either. And so the lack of quality data makes comparing these borrowers and these opportunities very, very difficult. So discovery, transparency, or lack thereof, really outdated processes. Every single deal is very different. And so you're going to be reading paperwork every single time, trying to understand what goes into it. And because it's historically been very inaccessible, the minimums are also super high. And so the opportunity to actually get involved in it is very, very challenging. Now, that's where we come in, right? Our platform connects accredited investors with these borrowers and these underwriters to be able to actually make these investments and deploy capital into things that can diversify beyond your traditional public equities and public fixed income and get the yield that you're looking for when everything else is extremely volatile. And so our platform helps you source investment opportunities structured by these underwriters and make that investment directly. But the key here is that this is actually for accredited investors. And so just to clarify for those who don't know, what is an accredited investor? It could be an individual, it could be a business entity, and it allows them to invest in things that may not be necessarily registered directly with the financial authorities. And so these investors have explicit permission from the regulatory bodies to make these types of investments. And the criteria for that is really income that exceeds $200,000 or $300,000 with a spouse, a net worth of over $1 million outside of your primary residence. You can actually get certified using professional licenses like a Series 7, a 65, or an 82. And then also you could be an entity with at least 5 million in assets under management, or you could be a state registered investment advisor. So those are all things that qualify essentially for you to be an accredited investor. And for better or worse, unfortunately, that's all we're allowed to be able to do from a regulatory standpoint. That's the only types of investors we open up on our platform for. Just want to provide that as a caveat here today. So with that, Kraft, you want to take away, what is understanding private credit essentially?
Yeah, absolutely. So when we take a look at private credit, I think it's important to kind of distill it and effectively compartmentalize it into two broad categories that we use here at Percent. But before diving into the categories, at its core, these are really privately negotiated loans and debt financing from a variety of different types of lenders. The borrowers could be small businesses, they could also be consumers, but really the private credit industry caters to a variety of different types of underlying obligors. The deals themselves, could take on the form of looking like a consumer loan. It could be a venture debt offering, or other forms of private debt. And when we look at the kind of universe of private credit and drill it down into those two main categories, as I mentioned, we think about this as asset-based lending or corporate lending, if we're facing businesses specifically. To make a clear distinction of what we do here at Percent versus some of the other kind of more peer-to-peer lending platforms that have existed before us. All of the loans on the Percent marketplace are commercial loans. We are not lending directly to individuals. That's not what the platform is designed to do. These are all commercial loans that are being lent to businesses. Those businesses could be lending businesses in and of themselves, or they could be, a business creating widgets in a variety of sectors. But in either case, the financing types that we like to kind of categorize those into are either asset-based lending or corporate lending. On the asset-based lending side, this is really, looking to secure and collateralize deals by the assets that these companies have on their balance sheet. They could be in the business of actually extending loans to other companies or consumers, in which case they're non-bank lenders. And in those cases, they originate assets as a living. And we typically put those into SPV structures. And ultimately, investors are getting exposure to the cash flows that are associated with those assets that are in those kind of segregated bankruptcy remote vehicles. In other cases, it could be a company that is creating widgets, and they just happen to have assets on balance sheet, whether it's receivables from customers, or it's inventory or something else. That could also be considered an asset-backed kind of lending activity. So, just kind of broad brushstroke categories within asset-based lending. We've seen, lenders specifically extending credit to small businesses, so SMB financing. It could be equipment leases, as I mentioned before, if the business has a lot of machinery or other equipment, trucks, et cetera, that could be a basis for asset-based lending. They could have real estate. The business itself could either own property, or it could be in the business of generating loans that are also backed by property. So some of them could be real estate oriented. And then on the other end of the spectrum, they could be facing consumers or individuals. And so, there could be lenders that specifically provide financing to individuals in the form of consumer loans. And there's a variety of kind of different, kind of subsectors within that as well. And discounted receivables and litigation finance are just other broad categories within asset-based lending. And those really are more applicable to, again, more lenders than companies creating widgets. On the corporate lending side, this is really not asset-backed or asset-based in any means. These deals could be secured by assets, but it's not necessarily the assets that is the primary source of repayment. The primary source of repayment for corporate deals are the cash flows of the company, if they're cash flow based loans for profitable enterprises that have excess income that can ultimately satisfy debt obligations that the company may have outstanding. This is very kind of traditional in terms of credit metrics that we would use or any underwriter would use to assess the creditworthiness of a borrower, how much excess cash they have, EBITDA against kind of debt outstanding, interest coverage, so on and so forth. And then the other category within corporate lending is extending credit to companies that aren't profitable, that could be backed by high growth kind of venture type of investors. So these are considered venture debt, venture credit for companies that are in high growth mode. And the factors there in underwriting those deals are quite different from kind of cash flow based loans, because this is more about understanding the basis for why they need the credit right now, where the source of repayment is going to come from. If it's not going to come from cash flow, it's going to have to come from either another round of equity financing, or it's a bridge to another debt financing, or some other kind of thematic situation. So these are all kind of very situational, but in return for that higher degree of risk associated with those deals tend to have higher interest rates associated with them as well to balance out the risk return ratio there. So at a high level, that's kind of how we divide up the universe. And then diving further into just kind of private credit as an asset class, as a market, we've seen and experienced tremendous growth over the last 15 years within this corner of the financial markets. This has largely been fueled since the financial crisis, where banks that were typically involved within the kind of business of extending credit to small businesses and consumers have largely taken a step back for regulatory reasons. And in lieu of that, that doesn't mean that the demand had went away. It just means that other players needed to step in to satisfy all of that demand that the banks left on the table. So since 2008, as you can see here, there's been a tremendous growth within the industry. This graph is specifically showing kind of funds that are involved in the space, and how much they have deployed versus how much kind of quote unquote dry powder they have from LPs that have invested in those funds. But it's a good barometer, a good kind of litmus test to showcase how much demand there is within this asset class, and it continues to grow and up and to the right, just given the fact that the banks don't have any increased appetite to service this end of the economy, and especially in light of the dislocation that we've seen over the last 12 months in a rising rate environment. Even the rates that companies, small businesses that could have gotten financing from banks have also risen in tandem. And so the rates that were offered in private credit land versus what you could get from the banks look more similar today than they ever have since the financial crisis, which leads to, well, what would be the rationale for why these obligors would go and try to raise money within private credit versus banks? And the answer to that is a lot of the lenders that are within this space really kind of build a business around extending credit much more quickly, much more efficiently, being kind of more of a partner than just a binary yes no type of bank lender. And so for all those reasons, I think it's actually private credit's time to shine at this point, and ensuring that consumers out there, whether they're small businesses or individuals, have optionality in terms of where they can raise debt. Private credit is extremely recession resilient, which is more important than ever as we kind of head into a challenged credit environment this year and perhaps further into next year. If we look at public equities, I think everyone here on this webinar can probably attest to last year being a very volatile year, to say the least. A number of kind of sectors, particularly in the technology space, reacted to the rising rate environment and just kind of multiples having far exceeded what they were historically, especially in the run up to the kind of the more kind of credit constrained environment that we're now facing today. And so given that the equity market has delivered substandard returns and negative in many cases, So from a volatility standpoint, equities is, clearly not where you would want to be, or if you are, you would want to diversify away from that. Private equity and kind of venture equity has, witnessed a similar decline, especially kind of in the later stage on the venture side. All of these valuations have typically predicated, where public market equities are trading in terms of a multiple. And, with the public markets having performed the way that they have, that has trickled down into the private market as well. And so, when the market recovers and when these companies are able to go public again, that'll, effectively reset. But we're already seeing that resetting in down rounds, in companies just simply not being able to make it and needing to effectively capitulate and perhaps sell themselves to other companies. So we'll see a lot more of that this year. But if you're an investor in this space and you've held, kind of private equity or venture-backed companies, if you haven't faced a write down yet, you probably will, especially if the companies are kind of later stage. And then on the public debt side, this has also been directly impacted by a rising rate environment. The issuance volumes have, been a fraction of what they were before, especially in the high yield market. None of these corporate issuers want to go back to market in a very rising rate environment, especially if they've secured debt financing recently. There's no reason to opportunistically refinance that. And so issuance volumes are down, but also credit investors within the public debt market have suffered losses for the first time in many years. Credit spreads have remained constant, but the risk-free rate, kind of the rate side of the equation, given what the Fed is doing, has obviously increased and has decreased prices. And so therefore, the public debt markets have not been, the safe haven that they have been in the past, in an impending recessionary environment. So that all leads us to private credit as, an asset class that we believe is extremely recession resilient because of a couple factors. It is largely not directly correlated with kind of where, any of these other markets are trading. Private credit is really, dependent upon the structures that are put in place between two parties, the lender and the borrower. And there's a variety of ways that you can kind of structure around being able to build in protections for yourself as a lender. These deals typically have a much higher coupon threshold as well. And they're not, usually priced off of, a benchmark like a LIBOR or a treasury. So it's really just a fixed rate for the most part, especially as you go further down the curve in credit. They're all unrated in nature. There's really no, again, correlation with public markets. They have shorter durations, shorter tenors, which means that these companies have to actually come back to market much more quickly and have to refinance their debt. And they have no choice to kind of, sit around and wait for the market to recover. So they are forced issuers. And, even though they may have flexibility in when they can refinance their debt, in this environment, they will likely not, exercise that option until they actually need to. But from a credit control standpoint and from, just an uncorrelated standpoint with the rest of the asset classes here, we think private credit's a great place to be. And we're certainly seeing that in terms of increased volumes, increased activity within the space. A lot of the larger credit funds that are, kind of well-known names have all doubled down on private credit. They've all raised, $1 billion funds to help facilitate the deal flow that they're seeing. Because we think that the smart money is headed in this direction, and we're excited to be able to provide access to this type of product to help investors like yourself diversify your portfolio. So in terms of performance, it's a misconception that private credit is kind of a quote unquote riskier product than other debt asset classes. If you just look at it from a default rate standpoint. This is data that's tracked by a law firm that is, kind of well entrenched in the space. And you can see here that, even historically and up until, the middle of last year, default rates have hovered around, call it 2% or so, particularly for the lower mid-market category, for any companies that are kind of less than $25 million in EBITDA, which is, frankly, the audience that the percent marketplace caters towards. That's kind of where default rates have been hovering. And in fact, haven't ticked up during the COVID, environment either, where a lot of small businesses were pressured and and under pressure. So to see that performance continue to remain consistent is obviously a great indicator. And so if you compare this with the high yield market, which, I would argue is probably the closest barometer in terms of credit market to the private credit market, because a lot of the issuers and borrowers from private credit ultimately graduated to the high yield market by obtaining speculative grade ratings from rating agencies. The default rates in this market are, fairly comparable, if not higher, frankly. It's hovering around 1.5% or so in the middle of last year as well, with, S&P projecting material increases on the default rates on this side, which, if you were to transpose the, increases in default rates that S&P is expecting to see in high yield on top of private credit, it's still extremely comparable. But yet at the end of the day, as an investor, you're getting compensated with much higher yields. High yield, currently is probably anywhere between high single digits to low double digits, depending on the, grade that you're looking at, whether it's triple C or double B. But private credit is certainly north of that. We're seeing, deals clear in our market in the high teens, up to 20% in some cases. And so you are getting compensated for, additional perceived risk, even though the default rates, as you compare them across both asset classes, would suggest otherwise. And so when we look at, issuers, and when our underwriters look at issuers specifically, and companies that they want to potentially do business with, diligence is obviously key. These companies are not, public filers. In many instances, they may not have audited financials. So there's a variety of information that, could be inconsistent from one company to the next. So the diligence that underwriters perform is really the basis for whether or not an investor should feel comfortable in, getting exposure to any of these types of deals. So from a diligence standpoint, Percent itself had been an underwriter from the very beginning when we launched the platform several years ago, to intimately understand what this process is and what it needs to look like in order to build a platform around allowing third-party underwriters to bring their own offerings and set a standard, essentially, so that as an investor, with a high degree of certainty that this deal that's been brought by this underwriter compares, this way to another deal that another underwriter brings to the platform. So that comparability is key, which Nelson will walk through in a little bit. But from a diligence standpoint, these underwriters are looking at the borrowers at the corporate level in terms of just their financials, how they've been operating, what type of technology that they're using to make their operations more efficient, external risks, internal risks, everything that you would expect to, see from a high level diligence, as well as, who the management team is, what's their background, where have they come from, what business do they have, and running this business, and what's the likelihood of success. And then if it's an asset-backed deal, assessing those specific cash flows and the durability and the quality of those cash flows is key. If you have an asset and it's income producing, you want to make sure that the income is consistent going forward. So that's why we really like loans. We really like kind of contracts that really pin the underlying obligor to that, to submitting those cash flows on a timely basis. Making that as kind of prescriptive as possible. So non-bank lenders that, happen to lend to consumers and small businesses, their entire business is predicated on, ensuring that they're originating high quality assets, high quality loans or loan-like products, so that they can, earn an interest margin on, what they're earning versus what they're paying in terms of the cost of capital. And so, that's why we have brought on a myriad of fintech lenders to the Percent marketplace, because we felt like those were great stewards of capital that we would want to raise and provide exposure to investors on. The diversification of those cash flows obviously is important. You don't want just one asset being the only income producing asset and relying completely on that. Historical performance, looking at how those have evolved over time, and then obviously pro forma credit metrics, seeing how all of that would evolve if you did actually have debt in place at the corporate level. What does that look like? And then finally, liquidation value, right? If everything that you thought was going to go to plan doesn't, what is kind of that final value, that salvage value that you could potentially used to sell the assets and recover value on the deal. And then finally, as you're looking at deal structure itself, that's where you can really embed a lot of those risk mitigants, as I was mentioning before. So it doesn't just come down to term, security, and rank, but there's a variety of kind of credit enhancements, protections that a lender can put in place. They're running different kind of scenario analyses based on, if I did put in this protection or this covenant or this restriction, how does that, impact, the probability of default or the loss given default at the end of the day. So all of that provides clarity to the lender as well as to the investors on our platform. And finally, modeling those cash flows and running those stress tests and seeing what all those outcomes look like is obviously key to any process. So the diligence spans not just at the borrower level, but at the deal structure level to make sure that the deal structure makes sense.
And we did just have a question come in, if you'd be open to answering.
Sure. Yeah, happy to.
So Amit asked, why would corporate borrowers go to private lending at much higher rates instead of going to a bank or credit unions who may offer lower rates?
Yeah, it's a great question. So in many instances, corporate borrowers are accessing private credit because they don't qualify for the bank financing, or the bank financing isn't enough for what they need in terms of proceeds for whatever they're looking to use the proceeds for. So in many cases, private companies may have, one rung of their capital structure coming from a bank if they qualify to begin with. And then the private credit deals are, kind of additional debt capital that they're raising because, what they got from the bank was insufficient, or they just simply couldn't get it to begin with because of a lack of history or because of the business that they're in. So like non-bank lenders, as an example, they don't get bank financing because banks don't lend to non-bank lenders. They'd ultimately get the same exposure that they can't get because of the regulatory burdens that are put on them. So that entire industry is basically kind of iced out of traditional commercial bank lending, as well as kind of earlier stage companies that may be unprofitable, obviously. So all of those factors kind of lead into why these companies turn to this market.
Great, thank you.
And going back to this slide too, this was a distinctly post-global financial crisis change, right? And so you're seeing banks take a step back away from a lot of this. And so like what Pras was mentioning, this market has emerged directly because banks took, a step back away from all this, and we've had other people step in to be able to help solve this problem.
And Forrest asked, could you please define the default rate in the context on your slide? So I know you had a few slides in default rate. Does that mean a lack of interest payments from the borrower, loss of principal for the investors, or potentially both? When I think they're the 2-3%, 2%.
Yeah, great question. So we have really tried to standardize all metrics in our platform. So obviously the numbers that we provided here are from external sources. So the way that they define default rate is kind of under the traditional lens of a missed payment happens, or maybe there's another trigger that debt had in terms of a covenant where it tripped it, and so it turned into a default. But in most cases, it's a non-payment default. So if they missed an interest payment, or if they missed a principal payment, or an amortization payment, whatever it might be, that's what we're defining as default. Now, whether or not the company was able to repay any portion of the principal outstanding after that default is not what's being reflected here. So that's what would be kind of the recovery, and there would be a recovery rate associated with anything that has defaulted, which would then give you kind of your loss given default metric.
Mm-hmm.
So this is very high level. It's the most conservative measure because there likely would have been some level of recovery, but we really want to track kind of what is the basis for just kind of tripping a default to begin with across both asset classes.
Okay, thank you. Thank you, Forrest, for asking.
Thank you. Great questions. Awesome. So if we go back to perfect. So that all leads me into basically discussing the structure, right? Because that is the ultimate kind of safety mechanism that lenders and investors have. And so when we think about loan structure, again, it's not just about term and interest rate. We're thinking about the actual credit enhancements that are put into a transaction and the covenants that can help mitigate against those losses that I just discussed. So if it's an asset-backed deal, there's a variety of kind of credit enhancements that are available to underwriters. They can segregate those assets into a bankruptcy remote SPV as an example. So rather than having kind of both corporate exposure as well as asset exposure, you can have them assign assets into another entity and then have the debt only being issued or that SPV being the sole obligor with perhaps a guarantee from the corporate. But that way, in the event that there are claims or other creditors that the corporate level entity has, those claims are not applicable to the assets sitting in an SPV, so long as all of the protections are filed. So the debt would need to have a security interest in those specific assets within an SPV that's free and clear of any other liens. And so all of that is kind of a structural enhancement, obviously, to make sure that the assets in question, the collateral that's backing the deal, is assigned and the value is really only exclusive to the debt that the lender or the investors have. You could also pull in kind of a cash reserve as another measure to mitigate against potential choppiness in the cash flows that are expected from that portfolio of assets. So you can draw on that to make the interest payments, and so that it doesn't just go into a default just because of some slight underperformance, and it gives the portfolio a chance to kind of recover and replenish the cash reserves. So that's another kind of credit enhancement to ensure the consistency of the payments related to the debt, and kind of adjusting for and providing cushion against any volatility in the underlying cash flow of the assets. There's also other factors in terms of cash control within an SPV structure. So you could have a DACA account on the bank itself, on the bank account, so that the borrower in question, the corporate level entity, could have either access to that account, or the lender could just come in and take control over that account in the event of a default, so that there's no risk of the borrower actually siphoning funds away from the lender in an adverse scenario. So cash control is obviously key. And then there's kind of a variety of other factors like limited guarantees, personal guarantees. We see a lot of underwriters in the private credit space kind of lean on these as well. So they not only do an underwrite of the company, but in certain scenarios, they may look at the assets of the owners, of the operators, the CEOs, and see if they can put their personal assets up as additional collateral against the loan to their business. And then finally, liquidation preference. Obviously being senior in the company or in the assets has its benefits. You're ahead of any other creditor or any other investor. So being in that first out position is key, and needing to do that analysis on other lending agreements that the company has is obviously core to that, and being able to structure around it is a key benefit, and that flexibility is really only afforded in a privately negotiated transaction. Brandon, is there another question coming in?
Yeah, there was another one that came in. John O'Keefe asked, how are the sponsors compensated for bringing the deals to the investors and doing the handling of the due diligence to offer those deals?
Yeah, great question. So our model allows for third-party underwriters to syndicate their offering so long as it meets the eligibility criteria and the standards that we've set for the deals that can be listed on the platform. So the underwriters effectively are setting the terms with the borrowers and structuring the deal and doing the diligence. They're putting their reputation on the line, but in many cases, they're also putting their own balance sheet to work in the loan. And so if they're funding the loan, and kind of warehousing it and then turning around and selling it, a portion of that to the investors on our platform, there's an ability for them to make a spread there. So let's say they lend to their client at 20%, and the deal clears on the percent marketplace at 18. That 200 basis points is basically theirs to keep, less the fees that they that they're incurred by percent, which is not 2%. It's something less than that, but effectively it covers their expenses in the offering.
Okay. And so what I'm hearing is from deal to deal, this could potentially vary depending on what underwriters bring into the platform.
It does vary. There is a set fee model, in terms of fixed fees as well as a variable fee that percent charges. But the intent here is that, you know, the underwriters are able to structure the loan in a way where they are guaranteed a spread, a profit, so long as the loan obviously performs well. And there's an ability for them to have an upside on what they earn based on the level of demand from the percent marketplace as well. Because if that loan clears, in my example, at 16%, because there was an oversubscription at 16, and that could move forward at that level, then obviously they're earning more.
Okay. Thank you, John, for that question. So from my understanding, it seems like percent fees are pretty standardized across all on the platform. Depending on risk, demand, et cetera, that spread could really vary from the underwriter.
That's right. And the underwriters are also paying us a subscription-based fee to have access to the platform, the software, being able to see precedent transactions, get the market data, the color that they need to figure out, okay, how should I structure this deal based on what else has been done, have templates at their disposal. So we really make it a one-stop shop for, you know, these underwriters to leverage market data for the first time, arguably, within private credit.
And to add on to that, what we've essentially created is really market standard structures and market standard data that everyone can use. And so from that perspective, underwriters have a much easier time creating these deals. And that's why we also need to get paid because we are still running a business. But they can net their spread, which is absolutely fine. But everything from, you know, assessing assets and cash flows, assessing deal structure, like these are all essentially levers at their disposal that we can provide for them as a technology solution to make it that much easier to get a deal out the door. And that's why underwriters find so much benefit for leveraging Percent's platform. And I think John has another question. But yeah.
Right. Yeah. Okay. So we'll do this one in two parts, John. First, Percent, and then for Rocket Dollar. Are Nelson and Prath charging for doing the due diligence? So I think John is asking, who is doing the due diligence? You know, there might be multiple parties doing due diligence, but who's really doing the different parts of the due diligence before the deals become live?
Yeah, so the underwriters are the ones that have the relationship with the borrower and are doing the diligence. So everything that we kind of walked through on the prior page, we have a set of best practices that we've, you know, kind of come up with over the last 4 years in bringing these deals as an underwriter to the Percent marketplace. So we have what we believe are the standards for diligence. And so when a third party underwriter submits a transaction for potential listing on the platform, we are looking at what they did and whether or not, you know, it meets the standards that we've set for the market. So that's what we deem as kind of an eligible transaction. You know, if we look at their memo, did they kind of go through the entire checklist that we would have otherwise had if we underwrote the deal, essentially? And then we conform it to, you know, the exact kind of deal structure, the market data, the market data, and the market, you know, standard deal structure that's offered to investors for comparability purposes. So you can view Percent as being kind of the gatekeeper and as being kind of the compliance check as to whether or not these deals meet the eligibility criteria or not before they get listed.
Okay. Yeah, and thank you, John. John says he understands now, so thank you for explaining that. And I think you just asked about Rocket Dollar, so I can provide context. You know, Rocket Dollar doesn't take any payment to do webinars like this. These are really fully educational. Like, we don't have a financial relationship for anything that we're doing, like webinar promotion. So our fees are basically flat fees to the investors so they can open an IRA. That gives exciting access to Percent and so on. We just have our standard Rocket Dollar fee. No one pays to promote and be on these webinars. All right, thank you. Thanks, John.
Thank you. Great questions. Great. So just to finish up on this slide, then, from a reporting requirement standpoint, you know, we want to ingest as much information from the borrowers directly as well as the underwriters on, you know, how that company is doing, how the assets are performing, even after, you know, a deal has been closed. We found this to be extremely beneficial and valuable for investors and for, you know, the rest of the market alike. If you think about kind of public market standards, it's a quarterly filing. For us in this market, we believe that quarterly was, you know, not the best standard, just given that a lot can happen in 3 months, especially for a smaller company that has small company risk. And so we instituted surveillance reports that are published as often as weekly. And, if it's not weekly, then it's typically at least monthly. And, we think that's important because, while an investment is outstanding, and there's nothing actionable per se by an investor while that is outstanding because there is no secondary market for this, it still gives a fair degree of comfort and clarity and confidence that the investment they made was a sound one. If there is deterioration in like an underlying asset portfolio, or if the company isn't doing as well as we had all hoped, you'll see that in the reports. And in the event that they come back to the market to refinance their debt, that's when you have more knowledge at your disposal to make a decision as to whether or not you want to continue your exposure with them or not. So it's not like you have to kind of catch up on the credit all at once when another deal for the same borrower comes back. You've been kind of in the loop the whole time, which is, I think, really important and really compelling for everybody. And so we kind of track all of these kind of functions, whether they're KPIs or specific kind of credit metrics within those surveillance reports that are offered to all investors. And then finally, from a covenant standpoint, there's a variety of covenants that are either performance-based or just reporting-based, information-based, negative covenants, affirmative covenants. This is just a small sample set of what we typically have in our deal documentation. But underwriters in this market are acutely aware of needing covenants in order to put guardrails around what a borrower can and cannot do while they have debt outstanding with that lender. This is kind of debt 101, frankly, for private credit. And we, as a platform, have best practices again around what we think is the standard covenant package of what should be put in place for whether it's an asset-backed deal or a corporate deal. And so we're assessing whether or not the covenant package that underwriters are presenting to us kind of meet the standards and meet what we would have done otherwise on our side, having looked at the credit profile, looked at the cash flows, looked at the prospects of the company, so on and so forth.
We had another question come in. I don't know if this is super relevant right now, but I think it's important to answer. When you let's first talk about forgetting about an IRA, a standard taxable account. So let's say someone has invested maybe in 2 opportunities on percent. Wayne asked, when you do year-end tax reporting, is that typically done to the 1099 INT? So the distributions are ordinary income. Is that correct?
That is correct. So these are debt, securities, the Reg D notes that investors are effectively holding in their account. And so if that is sitting in an account that's not tax advantaged, they are indeed getting a 1089 INT, and it is ordinary income taxation treatment.
Mm-hmm. Yeah. So
at least from a logistical standpoint, though, to make your life a little bit easier, we issue 1 1089 for every country that you invest in. And so, for example, if you invested in 20 deals, and let's say 15 of them in the US and 5 of them were in, let's say, Mexico, which we have, lots of different Mexico-based opportunities, then you would get 2 1099s, one for the US investments in aggregate and one for the Mexico investments in aggregate.
Mm-hmm.
Yeah.
And with your Rocket Dollar IRA or solo 401k, we're going to keep fleshing out the instructions on our details page. So just make sure that, obviously you're working with percent. All the investments are titled, and your account is titled the name of your IRA or solo 401k. It is still fine to receive those 1099s, but you are not going to be filing those on your taxes because you are not paying taxes inside of an IRA or a solo 401k. All right, a ton of questions just rolled in. Thank you, everyone. All right. Amit asked, if the borrower's performance deteriorates or there are any red flags popping up, how does percent ensure that the investor's capital is secured to mitigate the risk? And I think you mentioned the term recovery. That might be recovery phase.
Yeah, so I think it's important to distinguish between kind of seeing performance deteriorate and whether or not a default has been triggered. Because if a company is underperforming but still making its payments and hasn't tripped any of its covenants, technically the lender isn't really allowed to do anything, right? I mean, we can obviously learn more about why it's deteriorating, the underwriter can figure out whether or not there's anything that we can do to help, that they can do to help, any advice they can give, any parties they can introduce to, so on and so forth. But until they trip something, there's not much to do. If they do trip something, then it goes into a workout situation. So the lender would need to understand exactly, what had happened, which in, most instances, if not all, if the deterioration was there and it eventually led to a default, everyone kind of saw the writing on the wall. But in the event that it isn't a workout, that is basically a plan that needs to be put in place to maximize recovery. And so that's what the underwriter would do. They would work with the borrower to figure out exactly how we can, get all or at least most of, what's outstanding repaid in the shortest amount of time as possible. And really have, investors' best interests in mind, which goes back to my earlier point that, we love underwriters that come to our platform where they have skin in the game. Because if they're selling 100% of, the loan exposure to investors on our platform, it's really just the reputation that's on the line. But if they still hold, a substantial portion of that deal, then, they obviously have money at risk as well, and they're going to act in everyone's best interest.
Okay. And a question I have, I think, is adding on to this. I don't expect you to have exact numbers of this, but how often do those, initial default situations kind of work out where the business is going to continue? And I would say the contract relationship, it's a goal to kind of continue letting them figure that out in the next few months and restart payments, versus situations where the underwriters and all the parties kind of quickly go to aggressively recover the capital as quickly as they can.
It's a great question. I'd say it's very situationally dependent. If it's a situation where a borrower is experiencing like a seasonal underperformance, and that's leading to them not being able to make a payment or tripping a covenant, then I would say that is, a higher likelihood kind of full recovery event, because then that's just saying, all right, let's, defer the next, X amount of payments until you kind of get back on track. And, maybe we amortize the loan ASAP from that point. So, if it's just kind of an innocent, temporary performance issue, then, you would typically see a much higher likelihood of full recovery. However, on the other side of the spectrum, if it's, a fraud related issue, or if it's, something that's just, absolutely detrimental, like, something like a large customer exposure, decided to move away. So the cash flows aren't there, or, if it was an asset-backed portfolio and, there was a higher concentration to a specific geography, and that geography just happens to, suffer a natural disaster or something like that, right? Where, there is no time or, flexibility in the world that's going to bring those cash flows back to the table to recover on the loan. I'd say those situations would lead to a lower recovery, or perhaps even no recovery, if in particularly in like a fraudulent situation. So we've seen, across the spectrum over the last several years, kind of where these defaults come from. Each time that we had one, we, quickly went into case study mode and tried to figure out what we could have done to prevent it or mitigate it going forward. That's not to say that we've, seen every type of default situation under the sun, but we certainly think that, other underwriters, especially ones that are experienced, collectively, I think everybody's seen most of what could happen. And so that collective knowledge ultimately translates into, having a much higher quality deal for an investor, where it's not just, one underwriter that's bringing a deal, it's, us as well that's seen, our fair share of our deals as well as others. So hopefully that vetting process allows us to figure out what mitigants could we put in that deal to begin with, and make sure that they're in there so that we can avoid it altogether.
Okay.
And a lot of the things that you see on this slide actually are learnings from different defaults and workouts that we've had on our side. For example, cash reserves, and for example, obligor exposure and things like that Pratt had mentioned. Those are all things that we've gone continuously better at. And now that we've been able to kind of go through this process, we feel pretty confident in the sense that we've seen enough to the point where third-party underwriters are now coming on board to be able to leverage those same structures that we've built and learned from, to be able to actually make them that much better and protect investors that much more.
Okay. And another question from Stephen here. What has the percent's default been by deal, borrower, volume? For those deals to default, what have the, I think the new question that Stephen's asking, sorry, let me reframe it here, is what's usually the time to resolution, and how are investors notified? We haven't really discussed that when a default happens, or maybe a recovery process is starting.
Yeah, so investors are notified as soon as the kind of grace period is up for a payment to have been made. So like I said before, like the vast majority of defaults happen because of a non-payment, and so borrowers have typically a T+3 or T+5 type of settlement date for any payments, and if the payment isn't received, then an event of default is triggered. So investors are notified, and frankly, they know when it's happened because they'll see, the deal all of a sudden in default and in workout on the platform. They would get a communication around, why it is and what had happened to kind of put it into that status. And at that stage, it's rare that a plan has already been developed to, figure out what the recovery model could look like. I think at that point, the underwriter. And if we're the underwriter or somebody else is, it's a fact-finding mission and trying to figure out, okay, like what went wrong here. And if we knew that this was kind of coming, then maybe we would have had some information in advance. But typically at this stage, there's probably a week or two of trying to figure out, how this is going to play out and what the plan is to repay. And at which point investors would be notified around what that workout plan looks like. So I'd say it's notification of default, a few weeks thereafter, or perhaps sooner, if the underwriter was aware of the impending default, communication around what the workout plan is. And then from there, it's really hard to affix a time frame, frankly, to my earlier point. In some situations, again, it's temporary. It's a quick fix. It's saying, okay, let's forego XYZ payment, and then let's get everybody repaid after that. In other situations, if there's litigation involved, if the courts need to be involved, then it could be a multi-year process, unfortunately. And those are situations we would love to avoid, that every underwriter would love to avoid. But if the borrower becomes uncooperative for whatever reason, they usually leave us with little choice.
Okay. And we got a bunch more questions. So is there anything on your slides you really want to get to, or we can just keep rolling through these questions? I'll leave it up to you.
Yeah, I'll leave it to Nelson. I mean, I'm kind of covered on the private credit side at the very least.
Yeah, I think some of these questions are actually going to be addressed in slides. So I think we can answer the question. I'll bring up the slide that's relevant. So I think let's just keep going through the questions.
Okay. So Bob asked, how do you suggest an investor can get diversification on your platform?
Yeah, that's a very good question. So let me just pull it up real quick. There's actually multiple ways to diversify across borrowers and sectors, actually, which is a perfectly relevant slide. So we have plenty of investors who make direct investments into these different products that we offer in the asset-backed notes or the corporate loans, like Pratt had mentioned, in terms of the two different types of asset classes or core asset classes that we cover here. And that's because these investors want to kind of be very specific about how they allocate and build up their own customized portfolio. But what we do have in terms of more of a set it and forget it mentality is what we like to call blended notes. And that's going to be multiple different asset-backed notes in one blended note that you invest in, right? Or multiple different corporate loans that you invest in. And these are very thematic. It could be US only, it could be total market, it could be short-term only, it could be all these different things. And when you see it come up, you can decide whether that's interesting for you. And so there's going to be dozens of different underlying asset-backed notes that make up that one blended note. These tend to have a little bit of a longer maturity, but again, it is much more of a set and forget it mentality, and that just makes it that much more easy. We've seen investors invest only in blended notes. We've seen investors invest and double down on specific assets or sectors and then invest in a blended note to complement that based on what they're looking for. So that flexibility and variability is what we aim for, and to provide you as much optionality as possible as an investor. Okay.
And this is always an uncomfortable question, but I always think every finance and fintech company has to answer it. So Percent is VC funded. So someone is asking, what happens to all the investments if Percent goes under? Rocket Dollar gets this question all the time, so I'd love you to answer it.
Yeah, I'm happy to take the last part, and Nelson, you can dive into kind of how we're funded. We have a backup servicer in place. We have had one for the last several years. We wanted to make sure that when investors decide to make an investment on the Percent platform, that our corporate balance sheet isn't a factor in the likelihood of their repayment on that deal. That it's truly a direct exposure to either the assets in an asset-backed deal or the corporate in a corporate deal. And so our backup servicer is a company called Citadel SPV. They're very experienced in the space. They are also the accountants on each one of the individual SPVs that are the issuers of all the deals on the platform. They have access to our system. They know exactly who owns what of every note and within each SPV. So they would be the ones to service the notes in the event that Percent can no longer meet its obligations as a platform for whatever reason. So we've mitigated that from day one. And frankly, we had to, because it's not just accredited investors that are on our platform. It's also institutional investors that require that. And so, rest assured, as an accredited investor, you're kind of getting an institutionally standard, kind of deal structure and everything else, as we've been talking about here today, but also, kind of an industry standard bankruptcy remote, type of investment opportunity set that is distinct and away from, Percent's balance sheet.
And I'll just say, to answer the first part of that question, for those listeners on the call and those watching on the live stream, you can rest assured that Percent is in fact well capitalized at the moment. And you will see an announcement in the next, hopefully, I would say month or two, give or take, around this in particular. I'm not going to say exactly what the announcement is, but it will be a good thing to put your fears at ease on that side.
Mm-hmm. Yeah, we get the same question a lot at Rocket Dollar. So Rocket Dollar is, not an IRA trust company or custodian. We work with an IRA custodian trust company and then one FDIC insured bank. So typically our clients are either at a trust company with billions upon billions of dollars in assets, or they are in our partner bank, which is an FDIC insured account for all of their cash. So, the general theme of these two conversations is there are backup methods in place. Maybe, Percent or Rocket Dollar no longer existed. You might lose some UI or service, but there are backup methods to continue your actual investment. Okay, so Amit asked another question. You can choose to name them by name if you'd like, or just kind of generally describe them. Who are generally Percent's competitors as you see it in this space?
That's a great question. So there's some of them that start with a Y, some of them start with a G, some of them start with an F. No, but the reality is, there are no shortage of different alternative investment platforms out there. And I encourage you to look at all of them, right? Like all of that is only going to serve to benefit our industry as a whole. What I will say is that going back to a lot of things that we offer that are pretty unique, we really have something here that I don't think anyone else really does, which is the ability to provide a level of clarity and transparency around what we do that just doesn't really exist anywhere else, right? And so everything from, it's not just about the deals themselves. It's about how they're structured. It's about how you can see it's been structured very easily, how you can monitor it post-close. We've taken the concept of transparency to heart and made that core to our mission. And so I would challenge you to maybe look at the other places that have these similar types of offerings and see how much visibility you're getting into how it's been structured and how you can compare two deals against one another and how you can compare asset performance of those deals, underlying deals, against one another. I think we stand pretty apart on that front. And so we were very excited on that. We'll continue to enhance the work that we're doing on the data transparency side of the equation. And I think it shows in sort of the loyalty and the retention we have in the users of the platform that helped us get it to where we are today.
Great. Yeah. And in this alternative space, if you're a newer investor to it, that's typically one of the biggest challenges that you meet is some of these deals are done on a more person-to-person basis or, investment group. And that one group might have great visibility, but everyone else has very poor visibility. So platforms like Percent, that allows us to really open out this visibility, get more numbers, get more due diligence that you can do as an investor. Okay. That was the last question. So if any closing comments, we're about a minute over time, Nelson and Prat, that you'd like to make.
Yep, you're on mute.
I think we were supposed to get to this slide at some point, but I think we were plowing through Q&A the entire time. But I think the last thing is if you are interested in what we are building, then feel free to take a look at percent.com today. And we'd honestly be happy to hear from you. hello@percent.com, and also that's our phone number below. Any questions, we are always available to address them. And we hope you found this session to be informative around private credit. We think it's one of the most exciting asset classes today to be a part of, and we're very excited to share it more with you if you're interested in learning more.
Awesome, thank you. And last comment again, I know we had some late joiners. We will be posting this up on YouTube quite shortly later today. So if you check by later this afternoon or this evening, it will be up on our YouTube channel. All right, thanks so much, everyone. Thank you, everyone, for attending the webinar. Thank you, Nelson. Thank you, Brad.
Thanks so much.
Thanks so much.